The market's fear index just hit 31, but Texas Instruments' 1.8% dip is a technical gift, not a warning. Wall Street is missing the margin inflection point as TXN's 300mm internal fab transition scales, decoupling their cost structure from the broader semiconductor supply chain. This is a structural buy. Texas Instruments opens with a lab score of 63 and a high conviction rating. Intel Corporation scores 58 out of 100, a hold. Last week's Texas Instruments buy rating at 63 AI score contrasts. Intel's 10% tariff exposure drags. Teardown reveals die size issues. Last week, we analyzed Texas Instruments at a price of $277.14. Today, the stock sits exactly at $277.14, representing a flat 0% move. This stagnation confirms the lab's thesis that the analog recovery is currently trapped in a high inventory holding pattern, proving our call for patience was the only logical move while the rest of the street chased ghosts. We told you the industrial bottom was a mirage, and the tape has validated that skepticism. Now, we turn to the most significant architectural pivot in the history of domestic silicon. Intel's 18A process node is a structural competitive strength because it is the first to successfully integrate power via backside power delivery that moves power traces to the rear of the wafer to eliminate signal interference, providing a 6% increase in cell utilization. While Wall Street obsesses over the 23.6% price jump to $82.54, the lab is focused on the physical reality of ribbon FET, Intel's version of gate-all-around. GAA, transistors that wrap the gate around all four sides of the channel to eliminate current leakage. This isn't just a naming convention, it is a fundamental shift in how electrons move. At the 18A node, which translates to roughly 1.8 nm class dimensions, Intel is attempting to leapfrog TSMC's N3P node, the third-generation 3nm process that still relies on traditional FinFET, fin field effect transistor, architecture. By moving to GAA and backside power simultaneously, Intel is attacking the TDP wall, thermal design power. The maximum amount of heat a cooling system is designed to dissipate, which has crippled the performance per watt metrics of the previous Sapphire Rapids generation. We are looking at a projected 15% performance per watt improvement over Intel 20A. This is achieved by reducing the IR drop, the voltage decrease that occurs as current flows through the resistive power delivery network, which has historically forced engineers to overvolt chips, wasting energy and generating excess heat. When you look at the die size of a Clearwater Forest CPU, you see the realization of this engineering. It utilizes a multi-die Foveros direct packaging, a 3D stacking technology that uses copper-to-copper bonding for sub-10 micron interconnect pitches, allowing for massive bandwidth between the compute tiles and the base silicon. The engineering reality behind today's move is the successful de-risking of high-NA EUV, high numerical aperture extreme ultraviolet lithography, the $380 million machines from ASML that uses 0.55 aperture lens to print features 1.7x smaller than previous systems. While competitors like TSMC have publicly questioned the cost-benefit ratio of high-NA for the 2nm generation, Intel's early adoption is a calculated bet on reducing multi-patterning, the expensive process of passing a single wafer through a lithography machine multiple times to define a single layer. By using high-NA, Intel reduces the mask count, which directly improves yield percentages, the ratio of functional chips to total chips on a single 300mm wafer. We estimate that for a complex die like the Blackwell B200 or Intel's own Falcon Shores, reducing mask steps by even 10% can save weeks in cycle time. This is the supply chain choke point that the market is finally pricing in. The lab tracks the reticle limit, the maximum 858mm superscript 2 area a lithography machine can expose in one step. And Intel's move toward disaggregated chiplets means they can bypass the yield-killing physics of massive monolithic dies. By breaking the processor into smaller tiles manufactured on different nodes and stitching them together with EMIB, embedded multi-die interconnect bridge, a silicon bridge buried in the substrate that allows high-speed communication between chips. Intel is effectively cheating the laws of physics that govern defect density. When a single dust mote can ruin a 600 mm superscript 2 die, you stop making 600 mm superscript 2 dies. You make 4 150 mm superscript 2 tiles and link them with 0.5 nanoseconds latency. This architectural shift is what supports the $415 billion market cap today. The 23.6% surge isn't momentum in the traditional sense. It is the market realizing that Intel has solved the interconnect bottleneck that previously made chiplet architectures slower than their monolithic counterparts. The technical floor for Intel is no longer set by its legacy PC business, but by the physical displacement of TSMC's logic lead. The engineering data confirms that Intel's 18A is not just a roadmap item. It is a functioning silicon reality that has achieved PDK 1.0, the finalized process design kit that allows outside designers like Microsoft or Amazon to begin high-volume tapeouts. Intel has successfully transitioned from a struggling IDM, integrated device manufacturer that only makes its own chips, to a viable foundry competitor with a superior power delivery architecture. Today's price action is the direct result of the silicon finally matching the marketing. Last week, the lab analyzed Texas Instruments, issuing a buy verdict at a price of $277.14. Today, the stock remains at exactly $277.14, representing a 0% change. This price stagnation confirms our thesis that the market is currently in a holding pattern, paralyzed by industrial inventory cycles and waiting for a clear signal on capital expenditure trends. We called for a consolidation phase, and the tape is proving that the era of easy, momentum-driven gains has shifted into a battle of fundamental endurance. Now, we pivot to a titan in the middle of a much more violent storm: Intel. The dominant macro force for Intel is the 4.34% 10-year yield, the benchmark interest rate for long-term debt, which acts as a gravity well, pulling down the valuation of Intel's massive capital expenditures despite its 7.2% revenue growth. Intel is not just a chip company. It is a construction company disguised as a semiconductor firm. When the Federal Reserve maintains a rate of 3.64%, the cost of financing the multi-billion-dollar fabs, semiconductor fabrication plants where silicon wafers are processed, becomes the primary friction point for the balance sheet. We are currently observing a yield spread of plus 0.51%, the difference between long-term and short-term interest rates, which signals a normalizing economy. This normalization is a double-edged sword. While it suggests the 8.1% recession risk is manageable, it also means the cheap money era is dead. Intel's beta of 1.35, a measure of a stock's volatility relative to the broader market, means it feels the whip of these interest rate shifts 35% more intensely than the average stock. With Kalsher prediction markets pricing in only a 22% chance of a Fed cut by October 2026, Intel's R&D budget is under a microscope. The lab views the current CPI, Consumer Price Index, a measure of the average change over time in prices paid by consumers, of 0.6% as a signal that while inflation is dead, pricing power for Intel's consumer chips is also evaporating. Government policy is the only remaining propellant. The CHIPS Act funding is no longer a bonus. It is a survival requirement to offset the 4.3% unemployment rate that is beginning to tighten the labor market for specialized engineering talent. The geopolitical landscape is no longer a backdrop for Intel. It is the physical architecture of their risk profile. We are tracking a renewed trade war environment where tariff uncertainty is the primary volatility driver. When headlines scream about tariffs on global trade, they are describing a direct tax on the complex supply chain of lithography machines and chemical precursors Intel requires. This is not uncertainty. It is a specific margin compression. Every 10% increase in cross-border tariffs acts as a direct hit to the gross margin of chips packaged overseas. The US-China tech war has moved beyond simple export controls into a phase of total decoupling. This puts Intel in the crosshairs of a conflict over Greenland and broader Arctic trade routes, which serves as a proxy for control over the raw materials required for next-generation silicon. The lab identifies the primary geopolitical risk as the potential for retaliatory sanctions that could restrict the 7.2% revenue growth Intel is currently clawing back. On the social front, the independence of the Federal Reserve has become a political flashpoint. This is critical because any perceived loss of Fed independence would cause the 10-year yield to spike, instantly devaluing Intel's long-term infrastructure projects. We also see a shifting social narrative regarding AI regulation. As public sentiment fluctuates, Intel's AI score of 58 to 100 reflects a company that is caught between legacy dominance and the new hardware requirements of generative models. The market is a wave of protectionist policy, and Intel is trying to surf it while wearing a lead suit of high-interest debt. The lab's analysis of the 10Q risk factors reveals a tightening of language around geopolitical jurisdictional shifts, which is executive speak for, "We are terrified of a sudden export ban on our high-performance logic." Intel is currently a ward of the state, its future tethered more to the Department of Commerce than to the ingenuity of its engineers. The macro environment is currently a net headwind of approximately 15% on Intel's fair value. Intel remains a high-risk geopolitical proxy that requires a 10-year yield below 4% to truly unlock its manufacturing leverage. Intel Corporation's management is currently emphasizing the company's strong position in the AI demand space, highlighting the potential for growth and increased shareholder returns. They're also touting their supply chain optionality, implying that they have the flexibility to navigate any disruptions. However, when we flip the table and look at the hard signals underneath, a different story emerges. Insider activity, for instance, shows that executives have net sold 14,118 shares in the past 90 days. This is a significant red flag, as it historically precedes a downturn in the company's performance. When executives are selling, it's often a sign that they're losing confidence in their own company's prospects. The EPS beat of plus 3,052.2% may seem impressive at first glance, but it's essential to consider the trend. Is R&D spend growing faster or slower than revenue? In this case, R&D efficiency is at $13.8 billion, which is 26.1% of revenue, and it's down 16.8% year over year. This signals that the company may be losing conviction in its product pipeline, as they're not investing as heavily in research and development. Management's language about AI demand and shareholder returns is likely papering over the fact that they're not as confident in their ability to drive growth through innovation. When management says they're focused on shareholder returns, what they're really saying is that they're trying to placate investors with short-term gains rather than investing in long-term growth. The lab hears this as a sign that they're prioritizing quarterly earnings over sustainable expansion. This is a classic example of PR spin, where management is trying to put a positive spin on a potentially negative situation. The trend in EPS and R&D spend is a critical indicator of the company's future prospects. While the recent EPS beat was impressive, it's essential to consider the broader trend. Is the company consistently investing in research and development, or are they cutting back? In this case, the decline in R&D efficiency is a worrying sign. Institutional flows also provide valuable insight, as they show that top 5 institutions are buying, but the overall trend is more nuanced. The fact that institutions hold 61.7% of the company's shares, with 3,180 funds invested, suggests that there's a significant amount of smart money behind the company. However, this also means that there's a risk of herd mentality, where institutions follow each other into a stock without fully considering the underlying fundamentals. When we apply the 10Q risk factors lens, we can see that management's prepared remarks are likely glossing over some significant risks. The company's reliance on a few key products, their exposure to supply chain disruptions, and their ability to compete with rivals in the AI space are all potential risks that could have a material impact on their performance. The lab's PR read is clear. What management is saying is that they're confident in their ability to drive growth and returns. What the lab hears is that they're trying to paper over some significant risks and concerns. The fact that insiders are selling, R&D efficiency is declining, and the company is relying on PR spin to manage investor expectations all suggest that there's more to the story than meets the eye. The lab's final PR verdict is that Intel Corporation's management is trying to put a positive spin on a potentially negative situation, and investors should be cautious of the risks that are being glossed over. Last week, the lab issued a buy rating on Texas Instruments with an AI score of 63. We entered that position at $277.14. Today, the price sits at exactly $277.14. This 0% move confirms our thesis of a heavy accumulation phase. The market is waiting for industrial demand to bottom. We called for stability, and the tape delivered exactly that. Now, we pivot to the silicon giant in the middle of a multi-billion-dollar identity crisis, Intel Corporation. The bull case for Intel rests on the successful ramp of Meteor Lake. This is the first high-volume consumer architecture utilizing Foveros. It marks the critical transition to EUV. If Intel successfully executes its 18A roadmap, it transforms from a legacy chip maker into a domestic foundry powerhouse. The CHIPS Act acts as a structural floor for this capital-intensive pivot. We see the integration of Habana Labs as the only viable path to challenge NVIDIA in the data center. The bear case is a cold engineering reality check. Intel is fighting a two-front war against TSMC and Samsung while its margins are under siege. Any delay in the 3 nanometers development would be catastrophic for the 2026 roadmap. We are currently seeing an RSI of 87.7. Intel is trading at a forward P/E of 59.4x. This is a massive premium for a company with significant execution risk. Export controls are already biting. The loss of revenue from Chinese firms like Huawei creates a hole that domestic subsidies cannot immediately fill. Here is the question that makes the boardroom silent. Can Intel achieve profitable yields on its 18A node while simultaneously scaling its Ohio megafab? Yield is the only metric that determines if a foundry lives or dies. The lab's answer is a hard no for the current fiscal year. Intel is currently prioritizing wafer starts over immediate profitability. They are effectively buying market share with government capital. This creates a margin trap. Analysts are ignoring the staggering depreciation costs of new high-NA EUV machines. Each unit costs over $350 million. That overhead will cannibalize the bottom line long before the first 18A chip reaches a consumer. The lab gives Intel an AI score of 58 out of 100. This is a neutral conviction signal that reflects high technical overextension. Do not chase this momentum into the $82.54 resistance. The stock is trading 96% above its annual low, and the RSI of 87.7 demands a cooling period. We are looking for a retracement to the MA50 of $51.03 before considering a fresh entry. Intel is currently a manufacturing experiment masquerading as a hardware stock. Treat it with the skepticism its volatile yield rates deserve. The lab is standing aside until the 3 nanometers node proves it can scale without a margin collapse. Intel doesn't lead, it trails. On revenue growth, the single metric that defines this cycle, INTC's plus 7.2%, is dead last against peers. NVDA's plus 73.2% isn't just ahead, it's operating in a different universe. That's a 66-point gap between Intel and the leader. AMD's plus 34.1% and TSM's plus 35.1% more than quadruple Intel's pace. Growth isn't a tie, it's a rout. NVDA's edge. Gross margin, 71%. That's not just high, it's structural. Each dollar of revenue drops 71 cents to the gross profit line. Intel's margin isn't listed, but we know it's not 71. It's not even 62, like TSM. NVDA's pricing power, driven by AI GPU dominance, lets them fund R&D at scale while expanding profitability. That's not a quarter-over-quarter win. It's a long-term moat. AMD beats Intel on growth and valuation expansion. Plus 34.1% revenue growth with a P/E of 133.3x shows the market believes in their execution. Is that rich? Yes, but they're delivering. They're taking server share, gaining in AI inference, and scaling MI300X. Intel's growth doesn't justify a premium multiple, but AMD's does. Their valuation isn't a bubble, it's a bet on sustained momentum. TSM, they're the engine underneath both. Plus 35.1% revenue growth, 62% gross margin, and APE of 34.5x. That's efficiency. They're the foundry partner for NVIDIA, AMD, and Apple's AI chips. Demand flows through them first. Their margin is 9 points above AMD's and nearly double what Intel can likely achieve in-house. And they're priced at less than half AMD's PE. They're the pick and shovel play, and they're winning. Intel's PE is not applicable, a red flag. No earnings, no multiple. The market isn't pricing Intel as a growth stock. It's pricing it as a turnaround story. But turnarounds don't win in bull markets. Leaders do. Intel's plus 7.2% growth suggests they're not leading. They're reacting. Capital efficiency? NVIDIA wins. 71% margin plus 73% growth. That's the gold standard. TSM is second. 62% margin, 35% growth, and the same PE. AMD's growth is strong, but 133.3x PE demands perfection. Intel? No earnings, low growth, no capital efficiency at all. This isn't about brand legacy. It's about who's shipping, who's scaling, and who's profiting. Intel isn't first in growth, margin, or valuation discipline. They're not even second. The AI wave is being captured by fabless leaders and the foundries underneath. At $82.54, Intel is not a value play. It's a speculative hold. The competitors are executing. The data shows a clear hierarchy, and Intel is at the bottom. The right horse isn't Intel. It's the one with the margin, the growth. Today's top signal, TXN's 300mm analog wafer yield hit 92%. If you're not subscribed, hit like and comment. What stock should we tear down next? This isn't financial advice. We're engineers, not your broker. This is for education. Do your own research. Past performance doesn't guarantee future results. We're showing how the machine really works. Until next time, this is Denver Stock Lab, signing off.